We know that JPMorgan says, three-quarters of the correction is already done, but there's still so much uncertainty. How are you pricing all of that? We had even the virus deaths at exceeding 1 million now.
Well, I think in the next few weeks, there are two key events that we're watching out for. One, obviously, as you mentioned, is the potential rebound in the pandemic in the US, in Europe, even in Asia. The second one, obviously, is the US presidential elections and the congressional elections. I think these two are going to keep markets on its toes, and I suspect you may see a little bit more volatility as we go into the November 3rd election. And as a result of that, you might see a little bit more risk aversion coming through, i.e. stronger dollar, a bit more volatility in the equity markets, and some of the traditional safe havens may get a little bit more support.
How would you, hedge against all these uncertainties, risk reward? Would you be putting more cash aside first?
I don't necessarily think we should be reducing our risk exposure at this point, because ultimately we think the next 6 to 12 months, we should still enjoy a gradual economic rebound, especially if we see some breakthrough in vaccine developments or some new efficient rapid tests that are being developed. That could really help to boost markets. But in the near term, I suspect we should stay put. And if we do get some meaningful correction, 5–10% corrections in the equity markets, I think a lot of investors could use that as an opportunity to add to their equity exposure. So from that perspective, next few weeks, I would suspect stay put. But if we get meaningful correction, it's not necessarily a bad time to add to equities.
Right, and you're still constructive on stocks overall, Tai. I'm just curious. We have our question of the day that we're asking our viewers about what assets are the best guide for equities moving forward. You can't exactly rely on dollar-yen or treasury curves anymore. What are you watching out for the next direction for stocks?
Well, I think a couple of things. One would be the pandemic development, as mentioned earlier. The second thing would be the developments of some of the leading indicators like the PMIs, which we're getting in a couple of days' time, and also some of the macro numbers. But I think another important point to note will be whether governments and central banks continue to provide support. I feel more confident about central banks around the world really providing ample stimulus to the economy. Governments, I think we're starting to see some discussion or even debates of whether they should gradually reduce the amount of stimulus coming through the economy. In the case of the US, politics clearly holding things up. But in other economies, the fact that governments are running up huge deficit this year, seeing significant surge in debt, that could add to that debate whether they should slowly pull back. That, to me, will be very important in driving investor sentiment when it comes to equities.
And you mentioned about how dollar could actually spike leading up to the election. Is this more about the dollar regaining its haven status, Tai, or is this just a temporary short squeeze where we need to see more of those stretch positionings unwind a bit more?
I think it's both. I think you've had a very nice run for the US dollar to depreciate since March. And as a result, there may be some technical rebound. But as you rightly pointed out, if investors are feeling less comfortable with the pandemic, with the political environment in the States, they may go back to the safe haven currencies like the dollar, to some extent the yen and the Swiss franc. But another thing to bear in mind is back in March, when we had a liquidity squeeze in the bond market, dollar was clearly, again, a very important place for investors and corporates to maintain liquid. So I think the liquidity needs running up to the election may also be a factor in supporting the US dollar.
And Tai, looking at China, has been an outperformer. Will that outperformance continue? Valuation still looking cheap there. And having said that, when you take a look at China, will it continue to provide that cushion for EMs?
I think so. I think if you look at the pace of recovery, you've seen areas such as exports, car sales really improving in the past few months. There are still some laggards, such as broad consumption. We're just breaking even. We're just back to the pre-pandemic level. I think there's still more room to accelerate. Things such as passenger flights, travel data, those are still, not making full recovery. So I think this weekend, this next Golden Week, is going to be interesting to reflect on whether Chinese consumers feel confident and comfortable traveling once more. If they are, then we could see some of the lagging sectors in the equity market come back. And that, to me, is still a very interesting opportunity for China. In the longer run, obviously, you do have more foreign participations in the Chinese markets. The fact that we do have the Chinese economy recovering, way above the rest of the world, that to me still suggests that the Chinese market is somewhere that investors should not neglect.
There's so much interest in Chinese tech, Tai. I mean, how best to play Chinese tech? Some say perhaps ADRs are the way to go.
Well, I think you need a diversified portfolio to do that because clearly there's still lots of clouds hanging over above the U.S.-China relationship, especially when it comes to tech exports or even restrictions on exports. But at the same time, we do see a lot of companies, not necessarily specifically in the tech sector, but for example, in healthcare, financials, educations, they're using the tech platform to broaden their catchment area. That to us is a very interesting opportunity in China. So these are really spread evenly across both H shares, and even ADR. So I think it does take an active and diversified approach when we think about what's the best way to play China tech going forward.